Alright guys, so this is Mod 42 and it's our introduction to exchange rates. Apologies in advance because I am ad-libbing this one a little bit more than I normally do when I try and make these, but either way it'll get you the gist of the topics of how to understand and how to manipulate exchange rates. As it says at the top here, first a quick note that the practice problems that go along with these topics are available in the slides presentation that also includes this information. So do some practice problems to figure out how to manipulate exchange rates. And then we'll get into the kind of the next topic that goes with this. So first thing, an exchange rate at its most basic is the price of one currency in terms of another currency. And it really helps to do this by looking at both currencies side by side. So I'm going to create here a dollar market, a market for dollars, and I'm going to create a yen market, a market for Japanese yen. And as with most of our markets, horizontal axis is going to be really easy. In this case, the horizontal axis is the quantity of dollars, and over here we're going to put the quantity of yen. That's a Y with two little lines through it on the bottom there. The vertical axis is a little bit trickier. I'd like you to be really specific here. So the first thing to think is that on a dollar market, we are looking for the price of a dollar. But the price of a dollar is a little bit hard to figure out. We've talked in the past that in the United States, the price of a dollar is actually the interest rate. If I want to get a dollar from someone else who already has one, I pay them interest to borrow their dollar up front. But in an exchange rate, the price of a dollar we see is in terms of another currency. So really the best way to talk about this is that the exchange rate here is how many yen I am willing to pay or someone is willing to pay per dollar. So the vertical axis here is the exchange rate, but if we want to be really specific, the exchange rate here is yen per dollar. And in the yen market, it's going to be the opposite. It's going to be dollars per yen. How many dollars are people willing to pay in order to buy yen, or how many dollars do they need to convince someone to sell their yen? And my little kind of hint here, whatever is on the top of this market, dollar, goes on the bottom of the market and goes on the bottom of the fraction, right? Whatever's on the top of the market, yen, goes on the bottom of the market and the bottom of the fraction to kind of help you remember how to work that. Great. Okay, let's get to actually looking at these markets. Like most other markets, a market is made up of two basic components. There's the supply in the market, and I'm going to make my supply here, right? So this is the upward sloping supply of dollars. And then there's the demand in the market, a downward sloping demand for dollars. And there's not a lot to understand about why these are upward and downward sloping, but of course, the more yen I have to pay to get dollars, then the less I'm going to want to buy them. Meanwhile, the more yen someone offers me for my dollars, the more willing I might be to sell them. Right? And then we can do the same thing here again, though I'm going to actually do it in reverse, and you'll see why in a second. I'm going to do an upward sloping supply, not of dollars over there, but an upward sloping supply of yen and a downward sloping demand for yen. And the coloring here actually matters and is actually pretty helpful. So let's start with the demand for dollars. Think about what the demand for dollars is. The demand for a dollar is the willingness of someone to buy a dollar. But in this particular exchange, it's an exchange rate model, the willingness of someone to buy a dollar means they have to sell yen, right? By selling yen, right? What I want you to notice right away is that the demand for the dollar is linked to someone's willingness to sell their yen. If someone is more willing to buy dollars, right? If the demand curve of dollars here was to shift to the right, and we can do that really quickly and then I'll erase it, right? Someone is more willing to buy dollars. Well, the only way they could be more willing to buy dollars is if they were more willing to sell yen. Well, selling yen sounds like the supply of yen, right? This is the willingness to sell yen and receive dollars in return. Receive dollars in return, right? In other words, the demand for dollars and the supply of the yen are actually the same thing. If the demand for dollars shifts to the right, someone is more willing to buy dollars, they have to be more willing to sell their yen. The supply of yen also has to shift to the right. And the opposite is also true. If somebody is less willing to sell their dollars, or sorry, less willing to buy dollars, that means they're less willing to sell yen along the way. Right? And then this also becomes true on the opposite end, right? The supply of dollars is the willingness of someone to sell dollars, but in terms of selling dollars, they are going to receive or buy yen in return. And the idea of buying yen is, of course, the demand for yen, right? This is the willingness of someone to buy yen. And in this case, because it's a yen versus dollar market, it's their willingness to buy yen and their willingness to sell dollars. Because in this market, the only way to buy yen is to sell dollars. Right? Therefore, the supply of dollars has to be equivalent to the demand for yen. I know that sounds really complicated at first, but it's not nearly as complicated as it seems. In fact, it should be a little bit liberating. If I make one shift on one market, I immediately know the shift that happens on the other market. In reality, when we do most of our problems, we're only looking at one market, but to understand that a shift in the dollar market has to create a shift in the yen market is also important here. So we're going to add a couple things, right? So the demand for yen is equivalent to the supply of dollars, and the supply of yen has to be equal to the demand for dollars. And that's kind of our big first understanding of what happens here. Of course, we left out, as we started this, kind of putting in an equilibrium point. So we could come in here and we could say there's an equilibrium point rate E, and maybe we could say that that equilibrium point is 1 yen per dollar. 1 yen per dollar. And then we could actually do the same thing on the opposite side. We have an equilibrium interest rate, and we have an interest rate of $1 per yen. Quantities in these markets are actually not especially important. And so we're going to largely ignore the quantity in the exchange rate model, and we're going to focus overwhelmingly on the price side, on the exchange rate side, and the going rate. But let's do a quick practice just to show this at work and show why understanding these models kind of both working at the same time or working together is important. One of the most basic things to understand about exchange rates is that the demand for any currency is pretty much created by a need to buy goods, services, or assets in that economy. And what I mean by that, my spelling is way off today, huh? That economy. What I mean by that is that if somebody wants to buy something, right, in dollars, or really I should say in the United States, they have to have dollars, right? So if people want to buy American products, goods, if people want to hire American workers to do work for them, services, if people want to buy physical or financial assets in the United States, right, then doing any of that in the United States or in regards to the US economy requires you to have dollars. And that goes really for any import, any export, any capital flow. Even though you might not actually exchange the dollars yourselves, when you buy something on Amazon that is coming from China, somewhere along the line, you are in a sense demanding yuan from China. You're demanding Chinese currency, or someone is demanding Chinese currency in order to make the purchase of that Chinese good on your behalf. So there has to be an exchange there. So the demand for any currency is directly related to whether we want things from that economy. So we'll do a really kind of timely but basic example right now. In the middle of this coronavirus crisis, a lot of people are flooding to American assets, right? So our example here is that people want U.S. assets, right? People want American bonds. They want American government bonds. You know, we are such a stable economy generally that we see a flooding of money from all over the world into our assets in the middle of recessions. So if people want American assets, let's start on the dollar market. People want U.S. assets. Well, we just said if people want our assets, then they need our currency. So that means people are more willing to buy our currency. So we will shift this demand curve to the right. And we will show this as an increase in demand, right? And that increase in demand is going to lead to an increase in the exchange rate, what we call an appreciation. The dollar here has appreciated, and we could say that now people might be willing to spend 2 yen per dollar to get dollars because they are so interested in buying American assets that the value of the dollar increases as they want these American assets. Right? Well, what's going to happen in the yen market? And this is, again, the part that becomes maybe most critical in terms of understanding the entire operational flow that's happening between these economies. Right? Well, if people want to buy dollars, we said that in order to buy dollars, they're going to have to be willing to sell their yen. So the supply of yen is going to increase. Right? Supply of yen is increasing because people are more willing to sell yen and to get dollars. So as the supply of yen increases, as people become more willing to sell their yen or have less need for their yen, we see that the exchange rate for the yen goes down, it loses value. The term for that is depreciation. And as the yen depreciates, given that we have numbers here, we'll actually be able to see that now it should only cost 50 cents, half of a dollar, per yen. Right? And this is why using these two models together actually becomes so useful and so helpful, even though at first it looks complicated to be drawing two models side by side all the time. But here's what we ultimately see. When one currency appreciates, the other currency has to depreciate. And that is supported both by the shifting of my curves, right? That if my demand increases and that demand of dollars is the same as the supply of yen, then higher demand for dollars will make dollars more valuable, and a higher supply of yen will make yen less valuable. But it also makes sense because if one currency is being valued in terms of another, if we come all the way back up to these exchange rate fractions, right? If the dollars per yen goes from 1 to 1 to 2 to 1, as we watched here, then this fraction, then the reciprocal of that goes from 1 to 1 to 1 over 2, or 0.5 over 1, right? 1 over 2 is 1/2. So ultimately what we see when we look at exchange rates, what you should first be looking for is you should be looking for an indicator of which country people are interested in putting their money in. As people become interested in putting their money in that country, you can say, well, that the demand for that currency is clearly rising, and therefore the supply of the opposite currency should also be rising. Or it might be vice versa. The demand for a given currency is decreasing. People don't want to put their money into a country. Maybe there's a crisis in that country, or the goods are not valued anymore, or a tariff is reducing the demand for that country's goods. That's going to decrease the demand for that country's currency, and as the country's currency she sees less demand, that will depreciate, and that means that another country is going to see a decrease in the supply of their dollars available. If Americans don't want to buy Japanese goods, then they're not going to be willing to sell their American dollars. So check out the practice problems and the slides that accompany this. There are going to be one set of just base practice problems and an article that go with this. Use those, and I'll work on getting a video up that shares the solutions and the ways to think through those problems. Happy studying, guys.